All right, let's get straight to it. This week has been, well, a whirlwind, hasn't it? From tiny shifts in our daily routines to these massive global market movers, we've sifted through your sources to pull out the absolute must-know insights, giving you a real shortcut to staying well-informed.
And what's truly striking, I think, is how interconnected these stories actually are. We're going to navigate the ripples from technological breakthroughs, the direct impact of policy decisions,
Right.
and even the subtle influence of cultural stuff. Our goal is to help you connect these dots so you understand not just what is happening, but why it matters to your world. And this is all directly from the materials you've shared with us.
That interconnectedness sounds absolutely key. So let's start by unraveling one of the biggest drivers right now,
Yeah.
the AI revolution. Your sources really home in on two powerhouses, NVIDIA and Micron Technology, as well, crucial architects of this boom. What makes these two companies so uniquely positioned for like dramatic growth right now?
Well, with NVIDIA, it's more than just their dominance in graphics processing units, or GPUs,
Hmm.
which are the backbone of AI computing. Our sources highlight their expanding software ecosystem, things like Omniverse and AI Enterprise, which is creating a truly um, sticky customer base. They're building a whole platform, not just selling hardware.
That's a crucial distinction, yeah. And the numbers certainly reflect that. We're seeing forecasts like a Q2 fiscal 2026 revenue of, what, $45 billion, dollars, even with that $8 billion headwind from halted H20 chip shipments to China.
Exactly. And then you have Loop Capital projecting spending on GPUs, and custom AI accelerators could surge to $2 trillion by 2028.
2 trillion, wow. What's the significance of that number and also their Blackwell platform ramping up so quickly?
It signifies a massive structural shift. I mean, that $2 trillion projection means AI infrastructure could go from about 15% of global computation stuff to maybe 50, 60% in just a few years. It's huge.
Yeah.
And Blackwell, that's NVIDIA's latest generation of AI chips and architecture. Its fastest ever ramp up means the demand is just, well, unprecedented. There are even whispers, of a powerful new B38 chip specifically for China, based on Blackwell, which could include maybe a 15% revenue sharing deal with the U.S. It just underscores NVIDIA's central, almost indispensable role, even with a valuation around, what, 36 times forward earnings?
Absolutely staggering numbers. Okay, now let's pivot to Micron Technology. They're a critical AI memory supplier, right? And their financials are equally impressive. A 37% year-over-year revenue jump in Q3 fiscal 2025 to $9.3 billion dollars, and record free cash flow. So what's Micron's strategy to capitalize on this AI surge, specifically with high bandwidth memory or HBM?
Well, HBM. Micron is making a really aggressive push there. HBM is that specialized memory crucial for high-performance AI systems. They're aiming to match their 20-25% market share in traditional DRAM within the HBM market by late 2025, which is ambitious.
Yeah, that sounds ambitious.
And this HBM market itself is projected to just explode, from
Okay.
maybe $35 billion in 2025 to over $100 billion by 2030. They're also diversifying into AI-optimized SSDs and even, interestingly, radiation-tolerant memory for space applications.
Huh, space.
Okay. Plus, there's that massive $200 billion investment plan for the U.S. So all this positions them as a foundational player. And their current valuation, around 11.8 times forward earnings, is actually kind of surprisingly below its historical average.
Interesting. So when we look at this kind of explosive growth in NVIDIA and Micron, what's the broader market implication? Are we seeing a widening gap in the S&P 500? And what does this mean for an investor's strategy?
It clearly shows why the S&P 500's growth is so concentrated right now, doesn't it? The Magnificent Seven tech stocks alone account for 26% of Q2 earnings growth. Meanwhile, the other 493 companies only managed a mere 3%.
Just 3%? Wow.
Yeah, this narrow market where the top 10 holdings are nearly 40% of the index, it certainly raises an important question for investors about, well, diversification.
That's a powerful point about market concentration. Okay, so beyond NVIDIA and Micron, which other crucial players are maybe quietly benefiting from this AI boom, and why should we pay attention to them?
Excellent question. You got to think about the underlying infrastructure, right? TSMC, for instance. They're the essential contract chip manufacturer for giants like NVIDIA, Intel, Apple.
Right.
Everyone, basically.
Right, the foundry.
Exactly. And it's fascinating that billionaire investor Stanley Druckenmiller actually sold his NVIDIA and Palantir stakes to pile into TSMC. He apparently views it as a critical AI titan with a more, let's say, palatable valuation. Around 21 times forward PE compared to its over 20% annual earnings growth.
Interesting move.
And their chip-on-wafer-on substrate, or CoWoS technology. That's absolutely crucial for these AI-accelerated data centers. They're expanding capacity like crazy, too.
So TSMC is kind of like the silent, indispensable enabler behind many of these big AI names. What about the cloud computing side?
Precisely. Look at Microsoft's Azure cloud platform. It's a 25% growth in fiscal Q4, actually surpassing Amazon Web Services in growth rate. They're leveraging their software expertise, integrating AI directly into products like Office. It's a smart play.
Makes sense.
Broadcom is another one. They're vital for interconnecting all those AI data center components. Their CEO, Hock Tan, he projects the AI hardware market could reach $60–90 billion by 2027. And it's also worth noting, Amazon AWS's revenue growth at 17% year-over-year was, well, comparatively slower than Microsoft Azure's 39% or Google Cloud's 32%. And Google recently scored that significant $10 billion deal with Meta.
Okay, so for you, the listener, the key takeaway here seems to be that understanding the underlying infrastructure is absolutely crucial. Experts are suggesting you look beyond just the obvious names when thinking about the future of AI and your investment portfolio. Now, speaking of major market drivers, the political landscape is certainly making its own waves, especially around the Federal Reserve. Your sources highlight quite a, well, fascinating and pretty unprecedented situation with President Trump's attempt to remove Federal Reserve Governor Lisa Cook, citing allegations of mortgage fraud. What are the key allegations here? And more importantly, what are the immediate and long-term implications for the Fed's independence and ultimately the markets?
This is a truly significant development, yeah. Cook and the Fed maintain that a governor can only be removed for cause, and her attorney has vowed a lawsuit challenging Trump's authority. This has sent tremors through the markets. Treasury Secretary Scott Bessent supported Trump's actions.
Right.
And the president has explicitly stated his goal is to quickly achieve a Fed majority to push for lower interest rates, particularly to stimulate the housing market.
And how did the markets actually react to this political drama? What did we see in Treasury yields, for example?
But we saw a split reaction, which is pretty telling, actually. Short-term Treasury yields fell, anticipating near-term rate cuts if a more, let's say, compliant Fed were to take shape. But long-term yields actually rose, reflecting potential inflation concerns if the Fed's independence were compromised.
So fear of inflation down the line.
Exactly. Windshift Capital, for example, views a politicized Fed as a potential nightmare scenario, possibly leading to unchecked asset speculation and negative real yields. This raises a really important question for all of us. Beyond just the Fed, how are trade policies and the government's sort of growing involvement in private industry shaping our economic reality?
That's an excellent point. Let's delve into tariffs then. Your sources point out some surprising impacts, even on the crypto market. How exactly do tariffs on imported crypto mining hardware affect U.S. miners?
Well, tariffs on imported crypto mining hardware, mostly from East Asia, could certainly squeeze U.S. miners' margins. Makes their operations more expensive, right?
Sure.
And more broadly, tariffs tend to slow economic growth and fuel inflation by passing costs onto consumers, which could, in theory, reduce disposable income for riskier investments like crypto. Yet, paradoxically, Bitcoin's price has soared 76% in the past year.
Yeah, that doesn't quite add up on the surface.
Right. It shows multiple forces are always at play. It's partly due to the Trump administration's perceived crypto-favorable stance, plus the whole rise of Bitcoin and Ethereum ETFs.
That's a great example of conflicting signals. And, in a really surprising detail, your sources mentioned Lamborghini's CEO, Stefan Winkelmann. He said even the wealthiest buyers of like $400,000 plus supercars are pausing purchases because of tariff uncertainty. That's a powerful illustration, isn't it?
It absolutely is. There's a current 27.5% tariff on European cars, with a proposed 15% rate potentially coming. And Lamborghini is firmly committed to made in Italy, so U.S. manufacturing isn't really an option for them. It shows that even at the highest echelons of luxury, trade policy can cause serious hesitation.
Wow.
And beyond this, Trump has signaled plans for substantial new tariffs and also chip export restrictions on countries that impose digital taxes.
So we're seeing tariffs as a significant lever. But it's not just tariffs, is it? Your sources also reveal an increasing government role in private industry. For example, the Trump administration acquiring that 10% stake in Intel, a $9 billion deal. And Commerce Secretary Howard Lutnick even commented that the Pentagon is thinking about taking equity stakes in defense contractors like Lockheed Martin, calling it basically an arm of the U.S. government.
Yeah.
What are the implications of this shift towards government equity stakes, and what are the criticisms?
Well, these actions mark a significant shift, no doubt. Proponents might argue for national security or industrial policy reasons,
Hmm.
but critics, they say such actions go against free market principles. They could potentially distort competition and really blur the lines between public and private sectors. It's a fundamental question about the role of government in the economy, really.
So for you, the listener, these political and economic forces are definitely not just abstract headlines. They directly impact everything from the cost of your future investments to the price of goods you buy, and maybe even the stability of the institutions governing our economy. All right, let's zoom in a bit from these macro forces. How are innovation and shifting preferences actually playing out in our daily lives? Your sources highlight some fascinating developments in healthcare and real estate. Let's start with Eli Lilly's new oral obesity pill, or forglipron. It just delivered pretty impressive results in a late-stage trial. What makes this oral needle-free option such a potential game changer, especially compared to the existing injectable GLP-1s?
The oral needle-free aspect is, well, potentially revolutionary. Orforglipron is an oral GLP-1 receptor agonist. It's a class of drugs that essentially mimic natural gut hormones to regulate appetite and blood sugar. In the trial, patients with obesity and type 2 diabetes achieved an average 10.5% weight loss at 72 weeks, and significantly lowered blood sugar, too.
That's significant weight loss.
It is. And the convenience of not needing an injection, plus not requiring food or water restrictions like some other oral meds, that could dramatically improve patient adherence. Now, there was a slightly higher discontinuation rate due to side effects in the trial, but the broader context is that many patients leave trials for all sorts of reasons beyond just adverse events, often for access to other treatments.
Right, that accessibility factor seems huge.
Mm.
Okay, shifting gears to real estate. We're seeing some interesting shifts in the student housing market. Rent growth has slowed significantly, and preferences seem to be changing. What's driving this change away from luxury amenities towards maybe affordability and functionality?
I think it reflects evolving student priorities and, frankly, economic realities. Rent growth slowed dramatically, just 0.9% in July across 220 colleges. That's way down from 5.7% and 6.9% in prior years.
Big drop.
Yeah. Students are now prioritizing things like co-working spaces and just affordability over, luxury stuff like golf simulators. They're opting for cheaper rental homes or older buildings that can cost 30% less. And while new development is slowing down because of higher costs, the large flagship public universities, they continue to show strength. It indicates maybe a shift towards perceived value over lavish perks.
It's fascinating how these diverse trends can be surprising economic indicators. And speaking of surprising indicators, your sources mention the Taylor Swift effect.
Mm-hmm.
How does a celebrity engagement like hers, briefly causing a 3% pop in Signet Jewelers stock,
What?
how does that actually show us something about broader market sentiment?
Yeah, it's a perfect illustration of pop culture's surprising economic power, isn't it?
Yeah.
We've seen her Eras tour create a documented consumer spending bump. Even the Federal Reserve noted.
Right.
Now, her engagement announcement and the specific mention of a cushion-cut ring can create these immediate little spikes for related brands like Signet. It just shows how profoundly consumer behavior and market sentiment can be influenced by cultural moments and celebrity alignment.
Wild. And as another example of evolving consumer behavior, what's happening in the ongoing streaming wars? Specifically with Google's YouTube TV and Fox.
Right, another contract dispute. We're seeing the potential blackout of Fox channels. That's Fox Broadcast, Fox News, Fox Sports on Google's YouTube TV if a new deal isn't reached soon. Fox is reportedly demanding far higher payments. This is just, the latest battle in an era where viewers are increasingly cutting the cord from traditional cable.
Yeah, it seems constant these days.
It does. And YouTube TV, with its millions of subscribers, is even offering a $10 credit to affected customers. So these examples really show you whether it's health advancements, housing choices, or even the power of celebrity. Understanding these varied forces helps you better grasp the dynamic nature of our economy and how innovations and trends ultimately shape our everyday lives.
So putting it all together, what does this all mean for your own financial journey? Your sources offer some pretty clear guidance on navigating today's markets and planning for the long term. Given that market concentration we discussed earlier, what's the key advice for S&P 500 investors looking to diversify beyond those magnificent 7 tech stocks?
Well, the advice is pretty clear. Don't put all your eggs in one basket, even if that basket is performing exceptionally well right now. Experts suggest looking at maybe smaller cap stocks or other sectors like business services, financials, healthcare, sectors that could see significant upside from generative AI down the road. You could also explore international markets or things like equal weight S&P 500 ETFs to spread the risk a bit. Warren Buffett's $1.6 billion stake in United Health Group is a good example. It highlights his strategy of seeing generative AI potential in maybe less obvious sectors like insurance and healthcare.
Right, looking beyond the usual suspects. And on the flip side of investing, it's also crucial to have realistic expectations for long-term growth, isn't it? You can't just pick one stock and expect it to, make you a millionaire overnight.
Exactly right. Take Coca-Cola, for example. Investing $10,000 in Coke in 2025 is, well, very unlikely to make you a millionaire in 10 years. In the past decade, Coca-Cola's total return was about 145%. That significantly lagged the S&P 500's 286%.
Big difference.
Huge difference. Coca-Cola is better seen as an income investor stock, right? 63 years of dividend increases, a decent 2.91% yield, but it's not really a high-growth play anymore. The key takeaway here is to build a diversified portfolio of competitively advantaged companies rather than just betting on single 100-fold gain stocks.
That focus on diversified long-term thinking seems like a consistent theme from the sources. It's not just about picking investments, but about approaching your entire financial life with foresight, even in unexpected areas, maybe.
Absolutely. Look at Buffett's Q2 2025 purchases again.
Yeah.
He bought 12 dividend stocks. Chevron, with its 4.34% yield, 38 years of dividend increases, and a reasonable 20x forward PE that really stands out as a strong choice for income investors, according to the analysis. And United Health Group, we mentioned them, with a 2.90% yield and a low 36.8% payout ratio. That's seen as a strong runner-up. It just illustrates that focus on sustainable income.
Okay. And speaking of long-term planning, your sources highlight a sobering but incredibly practical aspect of financial planning that maybe many people overlook. The cost of funerals. What are the figures there, and why is pre-planning apparently so important?
Yeah, it's a crucial but often avoided topic, isn't it? The median cost for a traditional funeral, with burial and viewing, was $8,300 back in 2023. Cremation came in around $6,280. But crucially, these figures don't include significant cemetery fees, which can easily add another $3,000 or more.
Wow, that adds up quickly.
It really does. And funeral directors stress tree planning, not just to compare and lock in prices, although that's part of it. It's also to alleviate the immense emotional and financial burden on grieving loved ones, especially since life insurance payouts can take weeks sometimes, while funeral expenses are often required upfront.
That makes a lot of sense.
Yeah, so it's really about being strategic with your investments, setting realistic expectations, and recognizing that thorough financial planning extends to all aspects of life, even those parts we'd rather not think about.
Well, you've definitely taken us on quite a journey today. We've navigated the intricate world of AI hardware, explored the very personal decisions around end-of-life planning, and touched on the political forces and cultural moments shaping our markets. It's clear that staying informed in today's world really means connecting the dots across a vast landscape of information.
And if we connect this to the bigger picture, I think the rapid pace of change we've observed in technology, policy, consumer behavior, even investment philosophy, it means that adaptability and critical thinking are just more essential than ever for navigating both your financial and personal landscape effectively.
Indeed. So maybe a final thought to leave our listeners with. Considering the increasing intersection of politics and markets, from tariff impacts on luxury cars to government stakes in tech companies, and even the controversy around the Federal Reserve, how will this ongoing tension between centralized authority and maybe more decentralized forces redefine not just markets, but perhaps the very nature of economic power in the coming years? Something to think about. We encourage you to reflect on how these insights apply to your own decisions, whether it's reconsidering your investment portfolio, thinking about future expenses, or just observing the world around you with a more informed eye.